Welcome back, everybody. I hope you all enjoyed your quick 10-minute break. Just before we kick off the next session, we just put a poll out. You probably would have seen it already. The poll was on, do you prefer active or passive management? So feel free to answer that as you go through. So far, we've got 18 votes in, and it's at 94% active, which is what we sort of were expecting. So we'll be looking at that after the next session as well. So moving on to the next session. So obviously that question is going to tie nicely to our next Q&A session, mediated by our very own Sam Goldwater. For the next session, we have been very spoiled to be able to draw on the experience of not one, but two of our underlying fund managers. Sam Ruiz is joining us from Sydney. He's a portfolio specialist at T.Rowe Price, which has its headquarters in Baltimore, United States. Generate invests in T.Rowe Price's global equities fund, and this has been a proven winner for us throughout the years. Also, coming in from Australia, we have Arvid Strymon. Arvid is head of macro and co-portfolio manager of the global equity strategy for Magellan Asset Management. I understand that Arvid has had the foresight to shift to Byron Bay before Sydney's latest lockdown started. This sort of foresight is what we'd like to see in a portfolio manager. Generate's relationship with both of these fund managers started in our very early days in late 2012. They both have a long history of proven success whilst utilising very different investment strategies. If you would like to know more information on our speakers, click on our speakers section below, and don't forget to keep an eye out for the polls on the right-hand side of your screen as well. It's fantastic to have them both here with us today. This session, like I said, will be moderated by our lead portfolio manager, Sam Goldwater. So over to you, Sam.
Thanks, Mark. It is great to have Arvid and Sam with us today. Generate has been able to leverage off its strong relationship with both Magellan and T.Rowe Price over the years. Not only have they provided great long-term performance for our members, but having the ability to tap into their stock and macro insights has been invaluable. So let's get underway. I have some questions which I will ask to both Sam and Arvid. I tossed a coin, and unbeknownst to Sam, he won, so the first question goes to him. There are a number of challenges facing markets: supply chain disruptions, the regulatory clampdown in China, and the Delta virus, to name a few. How aggressively is your fund positioned and currently compared to on average?
Yeah, hi Sam, and thanks for having us to share a few thoughts on this. I mean, you've mentioned just a few of the things that we would say are creating an incredible conundrum in markets right now. And the way that we would describe that is we have this, these incredible counteracting forces, both positive and negative, as the world comes out of, this extreme acceleration, which we all know was fueled by huge liquidity in markets. And this was something really a phenomenon that happened globally. And what we would say right now is that a lot of the easy money in markets, if you were able to pivot early, if you were able to see the signs early last year, has been made now. So where that leaves us looking forward is we are being humble at this point, where it is, in our view, almost impossible to predict how the world does recalibrate. The things that we would say are positive on one side, there are negatives on the other side. We do have, the credit impulse starting to decline. We do have liquidity starting to come out of the market, or at least being forecasted, and the communication is coming from central banks on that. And then on the flip side of that, a lot of this liquidity that was injected into economies hasn't actually been released yet, and is some form of pent-up energy. There's unknowns like the virus, where there's positives on one side, with the vaccines seemingly being the pathway back to normal and to living with COVID. But we're acknowledging as well that it's impossible for us to predict future mutations, the necessity to have boosters, how much this can roll out through emerging markets and the timeline to that, which has huge implications for whether this is effectively, a global reopening, and whether that can be synchronized, or whether this is just something that in the future happens to be more domestic. So, there will be times in markets where things feel a lot clearer, where we have the data we need. We're just right now sitting right in the middle of the fairway in the portfolio with a beta of 1.0. Just acknowledging that, we don't want to be overly defensive or overly aggressive right now. And just with where markets are at, we think that it's prudent just to be really focused on the stocks we have in the portfolio right now, rather than adjusting beta or trying to, really play where markets go. And I think that just hopefully highlights that things are quite uncertain, and we're really hoping for more data over the next 3 or 4 months that gives us a bit more clarity there.
Great, thanks, Sam. And same question over to you, Arvid.
Well, thanks for having us both here. And how I would describe our risk appetite, I think it's really a question about risk appetite, is that our risk appetite to markets is as full as it more or less can be, on the proviso that there are clear things that we're avoiding at the moment. And you called out some of those risks: supply chain disruptions, high valuations, Delta variant, all those kinds of things. I would say that the portfolio, the way that we're thinking of investing at the moment, is the path of least resistance to markets is higher, but there are some things that you want to avoid. Now, I'll just talk about both of those in turn. Now, in terms of the path of least resistance to markets being higher, I think there's a lot of things which can push the markets higher. We've talked a little bit about the money that's sitting on the sidelines. I would say there that there is a lot of money sitting on the sidelines, but we're probably at peak stimulus from policymakers, and you're seeing this from the Federal Reserve. They're saying, well, perhaps we're going to start tightening rates at some point, and also the US government and the amount of money that they're spending as well. And so I think everyone knows that there's some infrastructure spending coming down the pike, but perhaps that's going to be a little bit later and a little bit smaller than what people thought. And if we're thinking what's coming down the pike after that infrastructure spending, which is really going to underpin growth, well, you know, we look at Washington, DC at the moment, and it's kind of hard for people to agree on anything. So it's almost like we're at peak stimulus at the moment. So I'd say that the path of least resistance to markets is higher, but I wouldn't expect the returns that you saw in the past year, because I think the past year was when that stimulus was at its highest, and I think it's about to roll over, or at least ease a little bit. In terms of what we're avoiding at the moment, I think you called out a few of those ones, and I'm sure we'll talk about some other ones as well. I think the supply chain stuff is really interesting from an inflation perspective, and we're thinking a lot about interest rates in the portfolio and how much interest rate risk we want to have in the portfolio. COVID has obviously been a theme for the past year, and we're thinking about what could happen if there is an escape mutation. I think I agree with what Sam said. It's actually a bit of a black swan, so you'll know it when it arrives rather than being able to actually predict it. High valuations, I think we all know that there are pockets of overvaluation. That's not really where we play anyway, so from our perspective, we're not really there anyway. China regulatory risk, I'm sure we'll get onto that, but that's something that I think is not something you could have a high conviction on where that's going to land.
Great, thanks, Arvid. So it sounds like you both think that the bull market is not likely to end imminently. So what do you think is the most likely to be the trigger for the bull run to come to an end eventually? We'll start again with you, Sam.
Yeah, I mean, that's a big question. I guess what we'd say firstly, I mean, I would agree with Arvid that, I mean, valuation in their own rights right now, particularly with where the cost of money are not extreme in our view. There are definitely pockets where, you know, we may see capitulation in some of the higher valuation, more extreme momentum parts of the market. You know, speculation has been extreme, and you only have to look at, various non-profitable software segments, cryptocurrencies, etc. I think at this stage, you know, a very significant pullback in markets could likely be catalysed by unexpected mutations of the virus. If news did come out that basically the pathway with current vaccines was something that was not going to be viable, that would be certainly something that would catch out the market here, particularly with where overall valuations are in the market. But for us, what I would say is, rather than saying, you know, do we think this second factor would be something that does, you know, bring the current bull market to an end, is that when we talk about valuations in their own right not being something that we believe can bring the market, out of this what feels like a never-ending run, is the credit environment. And while there's, I've got no doubt we'll get onto the topic of China, but while there's these huge headlines at the moment about whether, you know, Evergrande is the next Lehman moment, is that the credit environment overall, at least in the developed world, and the data we get from the US actually looks very, very strong right now. And the overall savings that have been accrued, particularly from households, I think it was last year in 2020, we saw around 22 years worth of savings in 1 year alone, at least on the averages for the past couple of decades. So for us, we feel more confident about the credit environment. We feel more confident about where markets can go, but agree with Arvid, it's just about adjusting expectations for what future returns might be. But I would have to say, if there was one thing in the near term, it would just be the virus and any unexpected and undesirable developments there.
Great, thanks, Sam. And Arvid, what are your thoughts there?
Yeah, it's an interesting one. I think that you need to sort of put it into two types of things which could trigger this downside risk. The first is things that we know about, and second are the things which are kind of unpredictable, okay? And I totally agree on the virus, but I put that in the unpredictable part because, as I said before, you'll only know about that once you read about it. So I agree with that. Let me just talk about some of the things which, let's call them known unknowns, okay? And I think the big one there, or the biggest one there, because there are a few, of course, at any point in time, the big one there would be interest rates and inflation. I think that, we all know the supply chain issues, okay? And I think that comes through, or it could impact markets via higher interest rates, okay? And I think that the other way that we might get a downturn here is if the Federal Reserve, and it's almost a policy error, and I'm not saying this will happen, it's just a risk, if the Federal Reserve starts to tighten more than people expect, or at least sends a signal that it's going to tighten more than people expect. And where they have had this communication error in the past, and I'm sure they've learned from it, so it's a risk more than a base case. But we know that there are some issues around inflation, and if they get the miscommunication, or the communication piece on that wrong, then I think that markets could become nervous even if interest rates don't rise. So I think that this whole uncertainty issue is something to watch, because I think that markets, as we've noticed in the past week or 2 weeks, markets are a little bit jittery. And when you get these shocks, I think that markets are in a state at the moment where they go, I think that there's a little bit of a risk here. The market's had a good run. Maybe I'll just put some money on the sidelines. And I think that it's really the shocks that we know about and whether they actually come true, and whether the Federal Reserve misjudges the communication. I think that's the big risk at the moment, particularly with inflation lurking in the background.
Sure. Thanks,
Yes,
Arvid.
Dan, can I jump in with one just interesting thing there? It's I completely agree with Arvid. But the one interesting thing I think is certainly an aggressive tapering is something that could really catch the market off guard. And what's been really interesting, if we think about what's been happening even in rates the past 12 months, is you've almost seen, some positive economic data points actually see yields compress, which is in some regards counterintuitive, but it's the market really saying that if we do get economic data that's too hot, that may actually precipitate this early tapering and a policy error, as Arvid said. And you've actually seen the market react with almost saying there's too much economic fragility, and you've seen yields decline. And one interesting thing that our multi-asset team has done here is just to think about that a bit more deeply, not necessarily when it comes to quantitative easing, but that next pivot in rate rises. And I think that that's something that gets the market, very nervous, particularly with us being at the zero bound right now. And when we've looked back at, all the pivots where we've effectively had the Fed readjust and rates have then increased back to the 80s, what's interesting is that, while you have had these very short-term bouts of volatility, and it was even a surprise to me, is that the 12 months prior and the 12 months following in each of these, at least for global equities, have actually had positive total returns. So I think that there's a lot here, and obviously we have to think about overall leverage and things like that. But we would just say that that's not an outright risk if we do get that. But I completely agree, if that is too aggressive and if it's not messaged well by central banks, that is a big risk for markets.
Right. Thanks, Sam. So let's move away from the macro side of things and onto some of your portfolio holdings. Both T.Rowe Price Global Equity Fund and the Magellan Global Fund have a number of US tech mega caps within their top 10 holdings. Arvid, firstly, how do you see the regulatory environment evolving for US mega cap tech companies?
Yeah, look, I think this is a really important question because these mega tech companies, they're structural growth companies. These are the companies which are going to outperform in the long term. So let's break that down. So I think that the first thing to think about here is how can you actually get regulatory risk occurring? And I think there's two ways, and it's important to distinguish between these two ways. The first way is through existing laws, and the second way is through new laws. And if we think in the US, where the politicians in Congress can't agree on much at all, then I think that we're not so worried about new laws coming in. It's more about applying the existing laws. And that's actually a safer outcome because new laws quite frankly, it could be anything, okay? So at least we know what we're dealing with here. It's all about applying the existing laws. So that would be the first point I'd make, is that this isn't like China, where new laws can just pop out like that. It's existing laws. The second thing I would say here is, well, what type of regulatory risk are we talking about? I'd say that there's, within the tech space, there are actually three flavors, if you like, of regulatory risk. There'd be antitrust risk, which is a competitive type risk. There'd be content risk, which we know Facebook, for instance, is facing this type of risk. And then there's privacy risk, okay, so data privacy, which is a big issue as well. And the point I'd make here is that when we're thinking about regulatory risk, you've got to think about which regulatory risk are you worried about, because companies are not all subject to the same regulatory risk. For instance, Facebook is subject to content risk, and Google, maybe that's more of a competitive or antitrust type risk. So I think that the second thing I would say here is really focus on what type of risk you're worried about, because the debate is actually quite nuanced. And the third thing I would say here is that I think that the regulatory risk is something that's going to stick around for a while. And there's a couple of reasons why. In the short term, I think the Democrats, who obviously are in charge in America, their big thing, I think you can explain absolutely every single policy that Joe Biden and his team have done by looking at inequality, okay? And so a lot of these tech companies, they don't produce inequality, they may inflame inequality at the margin, because there's a lot of sort of rich people getting very rich. But I think that regulatory risk is coming through that inequality lens, and it's going to last a little while. The other thing I'd say here about the US perspective, and we'll get onto China in a moment, but I think that the US is different to China, because you can actually observe the decision-making process on a regulatory front. Okay, in China, as I mentioned before, it just happens, and you've just got to wear it essentially. Whereas in America, you can observe what's going on as an investor, and so what that means is there's less uncertainty. Okay, so I think that you're going to have less chance in America versus China of waking up one day to a very adverse regulatory outcome. And the very final thing I'd say here is that what is different in America to China, which means that I would say regulatory risk is lower in America than it is in China, is that in America, companies can lobby the government. Okay, this really doesn't work in China, but in America, you can lobby the government. And I think ultimately what that means is that if the government is asking for this and the companies want something else, in America, it's a bit more of a negotiation. So you tend to end up in the middle, whereas in China, the companies, as I mentioned, don't really have that much bargaining power, essentially. And so they don't get much say over the outcome. So I think that in America, this regulatory risk is going to last. You've got to think about what flavour of regulatory risk we're worried about. And that means diversification, of course. And thirdly, it's, I don't think, going to be as bad as it is in China at the moment.
Right. Thanks, Arvid. Over to you, Sam.
Yeah, yes, Sam, we'd agree with a lot of Arvid's comments there. We think that it's probably going to be more headline risk over the coming years. And the one thing here is, what we have effectively next year is the midterms. And it's going to be, even though, Democrats really do have power to get this through Congress, they're really going to need to rely on some Republicans to sway here, which is very unlikely that we'll see that in the lead up to midterms, maybe after. But one of our key insights here, and one of the reasons why we don't think it would just be a near-term sentiment overhang, but we actually think that we're going to see a lot more headlines starting to hit and a little bit more investor concern in the near term, is what we've actually seen are some very progressives elected and nominated for the Federal Trade Commission, the FTC, and also the DOJ. And what we believe from, we have political analysts in the US and from meeting various industry groups and other, legal firms in the US, is that we actually think that there is a concern here, particularly from the FTC, that the current law construct actually doesn't allow fixing of some of these antitrust problems. So Lena Khan is actually someone leading the FTC here. She's actually authored a book called the Amazon Antitrust Paradox, which effectively goes into a lot of detail of how Amazon may be doing good for the consumer, but it's actually not doing good for competition. And the law currently is skewed to the onus needing to be on the commission, the trade commission or the department, to prove why they're doing bad by the consumer. But they're in our view going to try and actually bring forward a lot of cases that they are not intending to win at all. And that is something that we haven't really seen before. So seeing these mega caps dragged through the courts, but also ultimately, with the FTC being willing to lose, we believe that they're going to actually try and prove to government that the current laws actually need to be changed, because in their current construct, it's just not possible. So that is just a different dynamic where it's less about whether they are actually broken up. It's less about whether we do actually see any big aggressive actions upheld, but that we could actually see more cases come forward, which might just be bad for sentiment in the near term. Something that we have to recognise, a little bit of that overhang already exists. Stocks like Facebook are trading relatively cheaply versus the universe with this risk already to some extent priced in. But I think we just have to be ready for a bit more of this headline risk.
Yeah, can I just jump in there just very quickly? I'll just add, I think that I agree with a lot of those comments. The last thing I would say here is that if you're a company and you're growing, you're making a lot of money, then you naturally have a target on your back from the Treasury, because they're thinking, I want some of that tax revenue, okay? And we all know that the US government and its budget and its debt and deficit outlook is terrible, okay? It's terrible. They're going to have a deficit of more than 10% of GDP on an ongoing basis if you look at the Congressional Budget Office's own forecasts. Now, there's a couple of ways you can fix that. You can tax people more, okay? And you obviously don't want to tax voters, you want to tax companies, or you can spend less, which obviously impacts voters. So I think that taxation is another reason that you might want to think about regulatory risk or some of the things which Sam's talking about.
Yeah, makes sense. Thanks, guys. So let's stay with big tech, and given the size and reputation of your businesses, you both get incredible access to senior staff at these tech titans. Sam, firstly, can you share an interesting anecdote about an interaction your company has had with one of these companies?
Yeah, Sam, I mean, we're fortunate with our size to be able to meet, all the top C-suite of these companies. Someone like, Jeff Bezos, when he was, running Amazon, he at least tells us he gave 6 meetings a year to the buy side, and we were fortunate to get one of those hours face-to-face. We do have to be a little bit careful, just, sometimes, or all the time, a lot of the things that we do talk about in these closed rooms, it's a bit of a gentleman's agreement. We don't talk about too much detail. But what I would say in general is something that is overwhelming for us with a lot of these leaders is the extent to, while they may be portrayed in the media as, having these big egos or maybe having, a path that they want to push forward with regardless, is actually more so a lot of humility. And when we think about a lot of the meetings we've had, there is a general acknowledgement that it is impossible to predict the future and to be a lot more data-driven in how they approach the future. Jeff Bezos said that to us, that he really has no idea how a lot of this plays out, and they really want to learn fast but also fail fast. Someone like Mark Zuckerberg would tell us that he was really wanting to target India in the near term, but then failed very quickly and had to actually partner with Reliance to do that. I'd say finally someone like even Elon Musk, who had really shared his vision with us early, that he wanted to automate everything. He wanted machines that would build machines, and that just wasn't possible, and ultimately underestimated, the value of humans in that supply chain and just how they need to evolve and innovate. So generally, I'd say an anecdote across them is just that humility. And if there's just one more personal trait, I would say someone like Elon really stands out to us. We saw him on the West Coast about 8 weeks ago, and what really came out there was just, a real ability and willingness and keenness to get right into the detail and get his hands dirty. So with everything now around supply chain shortages and obviously how much chips matter for a company like Tesla, he tells us that he's calling, the CEOs of all the chip suppliers, the big chip suppliers daily, just to make sure that he can shore that up. So a few anecdotes there. Probably can't go into the nuances of individual conversations, but overall, very impressive management, and that humility is probably something that comes through.
Fantastic. And Arvid, how about some of Magellan's interactions?
Yeah, look, I'll just mention something that is coming out of Microsoft. I agree with Sam that this is a little bit of an edgy scenario to sort of tell people what they tell us in confidence. But I think that one of the big things is that when you're thinking about how you're going to make money, right? You really, over the longer term, you're really looking for things which are growing in a structural sense. And Satya Nadella, who's the CEO of Microsoft, he's been on the tape publicly about this as well. He's quoted the numbers. So tech spending as a proportion of world GDP is around 5% at the moment. He thinks that's going to 10. He said in around 10 years, but that's been accelerated with COVID. So in terms of making money and investing, you've got something here in terms of tech more broadly. We'll get into the nitty gritty in a moment. Tech more broadly is 5% of GDP. It's going to double as a proportion of GDP over the next 10 years, and maybe less than 10 years, because we all know that COVID has accelerated the take up of tech, okay? Because we're all stuck here. We're doing a Zoom call, of course. So when we're thinking about that, we go, well, that's interesting, because that means that we should grow fast. If you hitch your wagon to that as an investor, you should grow faster than the index or whatever your benchmark is, okay? And there are, as before when I was talking about, there are different types of regulatory risk or flavors of regulatory risk. There's different flavors of technology structural growth. For instance, one that's really interesting at the moment is the cloud. I think we all know that the cloud is changing businesses. I would say there it not only is making things cheaper for that sort of stuff, it's actually more secure. And if you're thinking about cyber attacks and all of these electronic vulnerabilities, the cyber security is a big issue, and the cloud really plays to that. The other thing I would say is, or the enterprise software companies are producing, it's almost a business staple. And what I mean by staple is it's something that you have to buy, okay, as opposed to something that you want to buy. So in that sense, it's growing and it's a staple. That's it's almost a double tick. Okay, that's something that's really attractive. So I think that the underlying growth that the tech companies are talking about and leverage to is really exciting.
Great, thank you. So let's move on to China, and a topic that is front and centre for a lot of investors currently. How do you see the regulatory clampdown in China evolving from here? And have you lowered or raised your exposure to China because of this clampdown? But if you could lead off on this one, please.
Yeah, sure. So I think there's a couple of questions in there. So in terms of the regulatory clampdown and how we see that evolving, I'd make a couple of points. The first one is that I think it's going to be thorough, okay? And the second point I'll make, and I'll explain these in turn. The second point I'd make is that the punishment that each industry or company is going to get really depends on their report card, okay? And that report card depends on whether they've been contributing to the Communist Party goals or maybe not contributing, okay? So let me go through those in turn. In terms of the first point, the thoroughness, I think that there's a couple of things here. The first is that a lot of what's happening is coming from Xi Jinping himself. And I think if you go back in time, a lot of investors were thinking, oh, there's a lot of news coming out of China. Do we listen to it? Do we not listen to it? If it's coming from Xi Jinping, you got to listen to it, okay? And I think that he is driving a lot of this. So this is, okay, red alert type stuff, okay? You've got to listen to this and pay attention. The other thing I'd say here is, in terms of it's going to be thorough, is that China, you've got to remember, China is a developing country, and its regulations are not at developed world standards. So there is always going to be some regulatory catch-up because, quite frankly, a lot of this, let's call it regulatory infrastructure, wasn't quite built yet. So I think that this is going to be thorough from a Xi Jinping perspective, but also from a infrastructure building perspective, okay? The second thing, and I'll get onto now, is the size of the punishments which are being dished out. And I mentioned it really depends on your report card. And what I mean by report card is you think about your report card, you've got some ticks and crosses, and it depends on whether you're contributing to the Communist Party's goals, because let's face it, they're in charge and they're very well entrenched. So you've got to keep them happy. Now, the after-school tutoring businesses had a lot more crosses than ticks, okay? They were contributing to inequality because it was really only the rich kids who could buy this stuff. They were helping to push up the costs of raising kids, so there was a headwind there to demographics, low birth rates and so forth. So I think that they had a lot more crosses than ticks, so they got a bad punishment, okay? They weren't doing much good, so guess what? They went to jail for a while. So the question is, what's the report card for the other companies here and industries? And I think if you look across the tech companies, which is, we'll get to Evergrande in a moment, but if you think about the tech companies, Alibaba, I'd say is probably a less risky than Tencent, because Alibaba does a lot of stuff in AI, which helps modernize China, okay, and helps them in their fight against the West, or however you want to think about that. Tencent, on the other hand, I think is a little bit different because let's call it around half of its business is in video gaming, and I think someone in China called video gaming or referenced it similarly to opium, which of course has a special meaning in China, negative meaning in China. So in terms of regulatory risk, look, I'd say that, and ticks and crosses on your report card, I'd say it's a mix of ticks and crosses. I'd say these big tech companies probably aren't have as many crosses as the after-school tutoring businesses, but there's a mix of ticks and crosses. And I would probably say that something like a Tencent, because of its gaming business and also its social platforms, which is a little bit edgy as well, maybe they have a little bit more ticks than crosses, but I'd say that Alibaba has more ticks and crosses than Tencent. I think that your last question was whether we've raised or lowered our exposure to China. We've lowered our China exposure, and the reason is we have less conviction on the profitability outlook. Okay, we still think that China is going to grow faster than the West over the medium term, but how much money are companies going to make in China? That's become a lot less clear and a lot less certain, or more uncertain. And we're not in the business of investing in low conviction ideas. We're in the business of investing in high conviction ideas. So that led us to reduce our China exposure.
Right, makes sense. Thanks, Arvid. Over to you, Sam.
Yeah, I mean, Sam, it's obviously a huge topic. I would agree with a lot that Arvid said. We've got a few different views, which is why these things are really interesting to hear different views on some of these things. But in the same way, where we often say for every company we want to be on the right side of change, I completely agree with Arvid. For us, the way we've been talking about this internally is just wanting to be on the right side of she, because what he wants will happen, and you need to make sure that you're not on the wrong side of that. I guess we're a little bit different. We've actually been patiently leaning into the sell-off in China. The market's, at a 40% discount to the US. It's underperformed the US by about 35% year to date. And what we're always doing is acknowledging the risks, but thinking about the risk reward here. And I'd say the insight that we have, we're fortunate we've got a team onshore in China and in Hong Kong as well. And we believe through that team that the policy direction is very much misunderstood by the West. And what you have here in our view is what effectively will be a short-term regulation response, and China going hard, primarily because they have this unique window where they've already hit their growth KPIs for 2021. So if you think about the low base that was created last year with huge negative contraction in growth in China, China was able to quite easily grow about 18% in the first quarter this year, about 8% in the second quarter. And from what we've heard from various leaders in China, there was a very clear directive for leaders across the country to slow down growth and use, in their exact words, this unique window where we can go hard now, fix up some of the imbalances around common prosperity, around leverage too. And what we very strongly believe is what Xi Jinping effectively wants next year, when I say this a bit tongue-in-cheek, when he re-elects himself as the leader forever, is he's going to want a very strong support from the people, and the common prosperity is something that's going to naturally do that, whether that's targeting cheaper education, whether that's targeting cheaper property, whether it's targeting some of these big monopolies that Arvid mentioned and making it easier for people to compete. And we ultimately, on top of that, believe, and completely agree with Arvid, that a lot of this comes down to an issue around demographics. And China, it's really, it's one thing to relax your one-child policy, but if it's too expensive for families to have one or more than one child, that's a problem. So next year, we believe that very much so coming into the National Party Congress, China will want the support of the people, which all this regulation encourages, but also they're going to want a strong economy. There's no way in our view they're going to want to have headlines of a contracting economy, bankruptcies, etc. So if that is right, we believe regulation will be short-term, and that provides a very unique opportunity to lean in at these valuations for the right companies. I would completely agree with Arvid. Alibaba is a very key holding for us in China. In the near term, we're a little bit more concerned because we think that it's going to be harder for them to increase their take rates or to do any meaningful M&A that furthers the monopoly. But long-term, it's a fantastic company. The one that I would just disagree with, one of our key additions to the portfolio has been Tencent. And the reason we like Tencent is we believe that they're in those structural growth areas that Arvid mentioned, but we also believe that they're more sheltered from policy risks. So we believe these things for a couple of reasons. They've been on the front foot with the government in trying to restrict some of this over and problem gaming. If we think about where the problem segment is for gaming, it's, in our view, in the under 16 category, and that under 16 category of gaming only makes up around 2% of the group earnings for the company, so a little bit sheltered there. They've got a $15 billion social fund that they already had before this, which was all about promoting equality in China, and particularly in the less urbanised parts of the economy. And if that's right, and the final point I'll make there actually is in their fintech business, they actually have one of the lower take rates of all their competitors in the industry. So they're not gouging. In fact, we believe Tencent has actually been under monetizing their user base and giving away a lot of services for free. So that therefore leaves us, if regulation is going to be a bit more constrained to something like Tencent because they were already on the right side of this, then we still have this huge opportunity, around fintech, around online gaming. They're only about, I think last time I saw 8% of global market share for the online gaming segment. They're very well penetrated in China, but there's a huge opportunity outside of China as well. So a bit of a different take, but overall, we think that if you are looking for the right companies on the right side of policy and you're thinking about sectors carefully there, that there is opportunity.
Great. Thanks, guys. There's some really interesting insights there. So let's stay with China. Evergrande has been all over the headlines in recent days. What's your view here, Sam? Firstly, is this likely to be a systemic event?
Yeah, I will be quite quick because categorically we don't think that this is going to be a systemic event. It's definitely something you need to watch. It is big. It is a big signal from the government. It's no longer, things can't fail. And if the government does let this fail, but that's controlling this from being systemic, that is an important sign for the future and just the overall risk that people take in these markets. What I would say, just a couple of numbers there. So in terms of all that outstanding debt, it's around 0.15% of the total system in terms of the China banking system, which is definitely something that can be contained in our view. But what we believe is the risk about that spreading out further across the Chinese banking system and this being a widespread issue, that the government will step in before that actually ultimately happens. And property particularly is an incredible, if not one of the most crucial segments for China's economy and growth. So we believe that ultimately it is engineered. They will let this happen, but we think it will be more orderly than disorderly and won't be systemic.
Great. And your thoughts there, Arvid? You're just on mute there, Arvid.
I think someone put me on mute. Apologies for that. So here's what I think. I would agree on the systemic or the financial stability side. I don't think there's a GFC coming in China here for much of the same reasons that Sam talked about. I think that the Communist Party or the government, however you want to think about it, they're obviously, they almost triggered this because they tightened up the lending to the real estate developers. But they're trying to fix the system. Okay, they're trying to do this to reduce risk in the future, and that requires some pain now. And I think this is entirely what you're seeing. And I think that absent a policy error, okay, I think that this is all we're going to sail through this. I think the risk here is not so much around a financial stability event, but around the economic impact. And again, I don't want to play this up too much, but just calling out the risk. So for instance, if you're in China at the moment, you've got some dollars to spend, you can either put it in the bank, you can put it into shares, you can put it into property or a wealth management product, which is essentially lending to Evergrande or some of the companies like this. But you can't go overseas, okay? So you're almost a captive investor, okay? So here, I think that when all's said and done, there's not much that people can do, okay? They're still going to have to put their money somewhere. So that should reduce the impact on the property market because there's nothing, quite frankly, there's nowhere else to put your money. So in terms of, the impact on property prices, I don't think it'll be quite as bad as what it might be in another country. In terms of the impact on, let's call it consumer sentiment, because I don't think consumers are going to walk out of this feeling better about themselves, quite frankly. They're obviously going to walk out feeling a little bit worse about themselves. So I think that this is clearly a negative event, okay? I don't think we can polish this up and say this is a positive shock, okay? But in terms of how bad that is, I don't think it's going to be particularly bad, okay? It's obviously not good, but it really depends on what the government does. And I think the government wants to teach these over-leveraged, over-debt-burdened property developers a lesson. And if it wants to teach them a lesson, it can't bail them out too early, okay? What it's got to do is almost, to put it simplistically, let them fail and then fix up the mess, okay? So I think this is a risk event, but I think that they can fix up the mess.
Yep. Great, thank you. So let's look at your portfolios again. And so if you could discuss a stock that your fund has recently added and the reasoning behind that decision, please. So Arvid, over to you.
Yeah, okay. So look, I think the one that I'll talk about is Netflix. Okay, I think we all know what Netflix does. It's where you watch 26 hours of TV a day. Okay, so the reason why we bought Netflix, okay, I'll give you a few reasons. The first one is that when we're thinking about structural change, so these are the things that occur and deliver above average growth. Okay, when we're thinking about structural change, you either get that by something that's growing quickly or something that's growing its share of the market quite quickly. Okay, and I think that this is one of those companies because it's changing the way that people consume TV. Now, TV is not a new consumption item. Okay, we've been watching TV for ages, but this is a different form factor. It's a different way to do it. And it's a change in form factor from pay TV, which was watch whatever you want on your TV, to, let's call it streaming video on demand, which is watch whatever you want, wherever you want. Okay, and I think that's more flexibility. So I think this is a structural trend. It's enduring. And so I think that this is, to put it simply, above average growth. The second thing here is that when you're thinking about above average growth, and this sort of goes to what we were talking about before, if you're growing faster than the economy or your competitors or other industries, you typically run into regulatory risk, okay? Or you run into the Treasury wanting some of your profits. Now, I would say that this particular structural growth story is relatively low regulatory risk because it's the same thing they're selling, which is TV. It's just a different form factor. So it's not an entirely new product or industry. Okay, it's just a form factor change. Okay, so I'd say that this is unique in that it is a structural growth story with less regulatory risk. I think the main regulatory risk is something along the lines of local content laws or in something like that, as opposed to antitrust and data privacy and all that sort of stuff. The next thing I'd say here is that Netflix is by far and away the leading player. Okay, so they have an incumbency advantage. And that leads me to the next point, which is that they are not just acting as a distributor or a pipe of TV content from the TV studio to you. They're also investing upstream in those TV studios. And what that means is that they're controlling their supply chain, essentially, okay? And we all saw the awards the other night where Netflix got a lot of nominations and won a lot of awards. Tells me they're kind of, that strategy is kind of working, okay? So I think that controlling your upstream supply chain, so to speak, there's a lot of issues with supply chains globally at the moment, but this supply chain, I think, is actually pretty safe. And then the last thing I would say here with regards to Netflix is that what's the average price that you would pay, or you're paying right now around the world to watch as much TV as you possibly can handle? It's on average in America, it's around $15 a month. Now you compare that to a cinema ticket, you can compare that to a Big Mac, or you compare it to a lot of stuff. That's really cheap. Okay, so if you're thinking about over the long term, if people would be prepared to pay more for Netflix or a lot of these streaming video on demand type services, I think the answer is it's pretty cheap at the moment, and that gives these companies a lot of flexibility to raise their prices and improve their profitability down the track. So that's why we've added Netflix to our portfolio.
Great, thanks, Arvid. And Sam, how about a stock that T.Rowe's recently slotted into the Global Equity Fund?
Yeah, Sam, what I'd say there is, we're thinking very carefully right now in a market that is pretty full, where a lot of stocks have run, I wouldn't say all of them well above where they should be, but generally things feel quite lofty, is looking for special companies that are a bit misunderstood and where the market has just left them behind. And a great example is, I would argue there's probably not a person on this call that hasn't used Zoom before, and Zoom video is actually the number one addition to our portfolio this year in 2021. And when we think about a stock like Zoom, this is a stock that's underperformed the broader market by 50 to 60% over the past 9 or 10 months. So deeply out of favour, despite it being the poster child of that COVID winner basket. So Yes, last year they accelerated their revenues by more than 300%, obviously showing how beneficial COVID was to their business. But what we think the market misunderstands is it's not about the core business as it currently stands, which is just 10 or so people from a business or an office using the video conferencing of Zoom. What we believe the future is for Zoom, so this is really a stock where we believe we can make a lot of money over the next 2 to 3 years, is we believe Zoom is going to use all the fame and all the new eyes that are effectively on their system as the preferred video conferencing product to transform into a total enterprise scale communications platform. What that means is think about being able to go to a company with 1,000, 2,000, 5,000 employees and saying, use Zoom, this is the contract price, and we will give you video, not just for your customers, but for internal. We'll give you phones, we'll give you webinar platforms, trade show platforms. And just to show you how, or the scale that this can accelerate at, and something we don't think the market fully appreciates right now, they've already launched their internet phone platform. So the largest scale, or the largest competitor just to internet phones, is a company called RingCentral, which is also listed. And it took RingCentral 2 decades to acquire 3 million users. When we think about Zoom, they were able to get to 1 million users just in 12 months last year alone. So already a third of their biggest competitor, and it only took them 12 months. Fast forward to April this year, so only another 4 months, they built that to 1.5 million, and they're blowing through that. So they'll exit the end of the year more than 2 million. And to put this into context, for a company at the end of last year that did about $2.5 billion of revenue, they can charge each customer just in this internet phone product $200 per annum. So if they're going to have 2 million users at $200 per annum, you've got an additional $400 million in the company, which is 15 to 20% of the total revenue base. And that just shows how Zoom, we believe, is going to expand to new verticals that create more revenue. And it's not about, and this is generally, I'd make a comment about the market at the moment, where the market's thinking quarter on quarter and which companies will decelerate just because COVID was such a one-time tailwind. We believe that if we think about the next 2 to 3 years, that all of that in aggregate for Zoom is going to be a very exciting business, not just for the small way that we use Zoom today, but for this being something rolled out across large firms all across the world.
Yeah, fantastic. And so let's stay with you, Sam, and can you talk to a stock that the fund has exited and discuss the sort of reasoning behind that?
Yeah, I might tweak that slightly, Sam. One that we've chosen to just leave a small foothold in because we do believe it's a very special company. It's one that we've heavily debated over the past 5 years. There's other people who have had big shorts in this company, is Tesla. So we effectively sold 90% of our stake in Tesla. It was about 4 or 5 months ago as the stock approached 1,000 on the market. And this is a company where they've really surprised us and the rest of the market on their ability to ramp manufacturing, to get more deliveries. They continually have been getting deliveries that have been above consensus. They're seeing a great margin shift with the Model Y. They've shifted a factory platform to China and selling through in China. All of that is margin accretive. What concerns us about Tesla, and this is an example of where we are looking for those structural growth companies, but valuation is very important to us, is just in our view, the valuation became far too extreme. And to give you an example of what we believe the market was ascribing to Tesla at those type of valuations, is thinking about 2025, so valuing this company, which is a pretty hyper-growth company, a little bit further out in the future, which you do need to do. 1 year forward multiples for some of these companies just look very extreme, is the market effectively was assuming a 20 to 25% penetration rate of EVs globally around the world, which is very bullish and unlikely in our view. Also anticipating a 5 percentage point increase in total global market share to above 20%, which is, again, unlikely in our view. This year, they're likely to do around 900,000 deliveries of total Teslas around the world. And by 2025, the market was thinking that could grow to 5 million, which is a 60% annual growth rate, which is unlikely. And in terms of the cathode demand, that they would effectively need 70% of the global cathode supply to get there. Again, very unlikely they'd be able to secure that. So for us, all of that together was extreme in the core business. And then the final point I'll make is Elon Musk is a great visionary, and he has these big goals. He's had things like solar, the Cybertruck, but also FSD, which is the autonomous unit. And when we think about the FSD unit in Tesla, at those valuations, when we back out all of the core units of Tesla, we found that was around a $450 to $500 billion valuation. Sorry, I think my Zoom's telling me to do something different here, which is not a good example for the Zoom stock story I just gave before. But when we think about that autonomous unit, $450 to $500 billion valuation, that's something that in our view is just extreme. So the best technology in autonomous driving in our view is Waymo. And Waymo last year in a private funding round actually got valued at $30 billion, which just shows how extreme the listed market price discovery was for autonomous and Tesla. So a great company, just not worth that price, and something that we would add to it if it fell back from here.
Fantastic. And Arvid, a stock that Global Fund has exited recently.
Yeah, I'll talk about a stock that we've actually already talked about, and it's one where we have an opposite view on, or at least I would say a slightly different view based on portfolio construction. But it would be Tencent. We've actually exited Tencent, and I mentioned before it's because of the regulatory uncertainty, because we just can't get a high enough level of conviction on where that profitability is going to land, or the permitted level of profitability is going to land. And look, I'm not arguing that the stock doesn't look cheap. I'm more arguing that you just don't know what the outcome's going to be, okay? And I think this really goes down to the portfolio construction where, we have this very concentrated portfolio of around 25 stocks. You can divide 100% by 25 to get our average size, right? And where we're willing to put that amount of the portfolio into something where we had low conviction, even though optically it may be cheap, and we said, look, no, we'll put the money somewhere else. So that's where we are on Tencent and why we exited. I would say that maybe even Xi Jinping doesn't know where this stuff's going to land. It is something that's very fluid. I think we all know that. Pick up the paper and we'll find out what's happening tomorrow. But yeah, we just didn't want to take that level of risk in the portfolio.
Sure thing. Good stuff. Thank you. So I think we've got time for one or two more questions. So firstly to you, Arvid, bit of a tricky question here, but we'll throw it out there anyway. So Apple is currently the biggest company in the world by market capitalization. What company do you think will hold this title in 5 years' time?
Yeah, look, I think look into my crystal ball, but I think if you're looking out, let's say 5 years or more, I think you've really got to think about the structural growth stories. Okay, I think the cyclical growth stories, the cycle probably isn't going to last 5 years. Okay, so I think you've got to start thinking about the structural growth stories here, and the company which is going to be number one in terms of market cap in 5 years' time, I think also it's got to be something that's pretty big already. Okay, so if I look at my crystal ball, I would say that it's probably going to be a Microsoft or an Alphabet. Okay, they tick both of those boxes, and then my third pick here would be an Amazon, which is again a structural growth story. And all three of those companies, I would say, from a Magellan perspective, are very advantaged businesses. Okay, so not only structural growth, but I would say high quality structural growth as well. So if I had to pick one, well, I'm actually picking three, but I would say that Alphabet and Microsoft would be the two most likely, and the runner-up would be Amazon.
Thanks, Alvin. Sam, what are your thoughts there?
Yeah, I mean, my crystal ball might not be as good as Arvid's, otherwise I might be in Byron Bay now and have had a haircut in the past 5 months. So that's a tough one. But I'm not going to give you too much new there. So I would agree those three companies are probably most likely. Not that that's something that we would ever debate and try to predict with pinpoint accuracy. The one thing I would completely agree with Arvid is just around where is this outsized growth coming from? And you think about these three business models all have some of the most attractive industry tailwinds that we can see. And I'll give you one anecdote of something that all three of those companies has that has really surprised us. And I would say there was not one analyst on the entire market, both buy side and sell side, that would have predicted this. And that's their cloud business. So what we've actually seen is, if we think about towards the end of this year, and these numbers are astronomical, is that Amazon's AWS cloud business is probably going to exit with a $60 billion run rate. growing in the high 30s% year over year, even though COVID was a huge year for them. So the comps were very tough, and with above 30% margins. So huge incremental profits being added to one of their fastest growing units. But what's really surprised us in the cloud segment is the ability for Google, Microsoft, and Amazon to all grow cloud at very, very high rates. Yes, obviously, someone like Google is having to spend around $10 billion of their free cash flow to do this at a loss and chase market share. And why I mention that is for two reasons. Number one, that the ability of these three businesses to all grow cloud at such extraordinary rates, to us, shows that the total addressable market is far greater than we ever imagined. So we believe, as a rough ballpark figure, that the addressable market now for cloud is above $1 trillion, which is not an estimate we would have put on that before, which just shows the runway of growth and how structural and persistent growth in cloud can be going forward. But also that this is a true oligopoly. For someone like Google to have to spend that amount of money to be able to not even compete at a profitable scale, but just to catch up and take some share, just shows that there's very few firms in the world that have that type of balance sheet that would be able to do that. So a true oligopoly probably comes back full circle to one of the first questions around antitrust and the ability for others to compete. But it is just the scale and how innovative these companies have been.
Yeah, nice one. Thank you. So lucky last question. What company has the best management team out of all the companies your fund is invested in, and why? And I probably wouldn't be surprised if it's one of the three companies that have been discussed in the last question. But over to you, Sam.
Yeah, I mean, Sam, that's probably one of the tougher questions. We have, to Albert's point, a very different portfolio construction approach, which is, we've got more than 200 analysts around the world. So we believe in a higher number of high conviction bets and spreading the risk across more names. So we do have upwards of 180 stocks in the portfolio. So picking one outright from all of those is tough. There's a lot of very good management teams. Well, one that I'd say that we have a lot of trust in and is a bit closer to us, given they were on the board of T.Rowe Price historically, was actually General Electric. So Larry Kolb, the CEO of General Electric, formerly ran Danaher, on the board of T.Rowe Price as well. But he is an amazing leader of people, but also instigator of change as well. And I mean, when you think about the track record of General Electric as well, it's the first time in the 126-year history of the company that they've actually appointed a CEO from outside the company. So something that I think talks to his track record. But already he's making some fantastic changes in that business that had some pretty big structural changes and selling off some non-core units to shore up the balance sheet. And that's an example of a very contrarian stock in itself that has been a very tough company. But under Larry Kolb, we believe that there's a great turnaround story in a company like that.
Interesting. And Arvid?
Yeah, look, I'd say that management quality is something that we look at and pay a lot of attention to. When we're thinking about investment, you think about business quality, which you might think about is the underlying quality of the business, but I think you definitely have to overlay the management quality layer there. And so you're thinking about the quality of the business and the quality of the management team. So that would be the first thing I would say. I'm going to politely decline to single someone out because I know it'll just may cause problems when people say, well, why didn't you choose me? But I'll talk about some of the things which I think are really important, okay, in terms of management quality. The first one I would say is that they need to be visionary, okay? They need to be someone who's not just a process person, okay? They need to be someone who can actually, I know this is a little bit, these words are used too often, but someone who can see around corners. So someone who's not reactive, but is proactive is probably a better way of thinking about it, okay? The second thing is, as much as I've said they don't have to be a process person, right? I think they need to be able to do the process stuff, okay? So you can't just be a manager who's this visionary, but can't actually get things done. I think they need to be able to get things done. And I would almost call that management 101, okay? The third thing I would say here is they need to have integrity, okay? And so I think this really goes to governance risk, okay, in terms of what they're doing with what is essentially your money or your client's money, and whether they're doing this in a way which is going to reduce the level of business risk. Okay, so I would say that they're the three things. I would say that the companies that we look at, we assess people on these types of things as well, management teams and companies and that sort of thing. But I would say that they're the things that you would really want in your management team, okay? Because that reduces not only the business risk, but it also maximizes the growth trajectory of the company. And I think that's really important.
Fantastic. Thank you. Well, that puts us pretty much bang on our allotted time there, guys. So just want to say on behalf of Generate and our advisors, a big thank you. Keep up the stellar long-term performance. And yeah, I'm sure our advisors found that all as interesting as what I did. So yeah, thanks again and have a great weekend, guys.
Well, thank you.
Thanks, Sam.